And good afternoon, everybody, and welcome to the Horowitz and Company pop-up Q&A webinar for December 21st, 2020. Thanks, everybody, for joining me this week and every week. As I mentioned, we do this to try to help you out with some of the questions that you have regarding, well, a lot of things that are on your mind in the area of finance and investments, everything else in between. You know, last week we started the conversation with we have a vaccine. It was this great news that was out there. Well, this week we have even better news in a way. We have two vaccines, but also maybe now a potential problem. Well, first, before we go anywhere, I just want to say hello to everybody and mention I'm Andrew Horowitz, and I'm the founder and the president of Horowitz and Company. A couple of things, a quick disclaimer here. Anything we discuss today is not a recommendation to buy or sell any security. Nothing that we talk about here is, in fact, a solicitation or advice on accounting or legal or investments in any way, shape, or form. So just make sure that you understand that. You can read through those disclaimers that are on your screen right now. Again, we do give you the opportunity to ask any questions throughout this. There is a Q&A panel that is available. You can ask your questions there and see what's going on throughout the discussion to see if you have any questions. And if something pops up in your mind, just at any given time, put the question in there and we'll do our best to answer it. We'll try not to get into any of the very specifics about any particular item, like, for example, a stock itself, but anything else is fair game. So you could do that when you think of it at any time during this conversation. So what we do here is we open this up with some of the things that are going on, some of the things that have happening over the last week or so, some of the things that we're looking at, and then open it up to the questions. So as long as there's questions, we'll answer anything that's out there. And of course, these are recorded. We do put them up on pretty much every week. Sometimes we miss one here or there, but over on the disciplinedinvestor.com. So you can get that and check that out over there. Information about how to get in touch with us is on the screen right now, which you can see. Phone number or email, website. Email is the best way, info@horowitzco.com, or the website is thedisciplinedinvestor.com. Either way is a good way to get in touch with us. So we got some good news. We got some bad news. That's what we got. Let's start with the good news. Why don't we? Last Friday, at the end of the day, after the close of the markets, the Fed announced that pretty much all the banks have passed stress tests, these really very stringent stress tests, and are available to restart buybacks and potentially enhance dividend schedules and up to certain limits. And that really, on that news in the after hours, the banks popped. I mean, Citi and Bank of America, Goldman, and Morgan Stanley, all of them just really popped pretty nicely. And they continued out throughout the day today, outperforming significantly. It's pretty interesting because it's, in fact, I'll go so far as saying it's weird timing, because we're right in the middle of a pandemic, right? We know that. We see that unemployment is extremely high considering where normal unemployment could be. And obviously that's all to blame for the forced shutdowns that we saw during the pandemic. We see that in the area of real estate, we have some problems in terms of mortgage delays and credit card charge-offs that the banks have, the fact that there is a significant amount of concern over loan repayment by the banks. And this is kind of interesting that right now, with all this uncertainty, that the Fed decided that it would be a good time to actually think about looking at allowing for banks to do share buybacks and increasing dividends if they were to do so. So I'm not exactly sure what that's all about, but obviously they had the good reason. They feel that the banks met the stress test parameters, which again is pretty interesting considering the fact that you have a lot of things that are going on right now that are cross currents and could in fact provide for more problems for the banking and financial sector if we see that there is some additional concern due to the pandemic. So that's kind of where we are right now. But yet, the banks are obviously flush with cash, coming off a few months ago where there was a lot of concern. The yield curve is doing a lot better for them. So I think this was a matter of the Fed trying to show that there was a significant amount of, they were feeling comfortable. On the heels of their rate decision and the FOMC rate meeting last week, that pretty much things were good. and saying that, well, we're going to leave interest rates low for a long period of time, them doing their best to widen that yield curve and create some better margins for the banks. So again, weird timing, but that was good news. We also had some good news on a new vaccine. Moderna is now able to, was granted emergency use authorization. We're seeing that in the United States, we have both the Pfizer and the Moderna drug. In the Europe, Pfizer was, I think just today, they announced that they gave emergency use authorization. In the UK, obviously that's going as well, going along as well there too. So there's some good news on there. And then what's happening, markets had a good week last week, generally speaking. Small caps hit a record. We're seeing a little bit of softness in some areas of the economics right now, but generally there was a significant amount of upside opportunity buying the, hitting the bid. There was a lot of good things going on. Now, the bad news, there was a little bit of that over the weekend and the continuation of this whole increase of case count, hospitalizations, as well as, of course, deaths. But now what we see is a new, they're calling it a variant, a mutation of the virus that's spreading in England, and lockdowns in Europe are increasing. We saw that we're seeing some border closings in Europe. They're saying, you know what? Hey, we're not taking anybody. We don't have anybody from the UK coming in here. So Europe sold off on the news pretty hard. The US dollar strengthened throughout most of the morning, then all of a sudden rolled over really hard back to that trend that we've been seeing to the downside overall. So US markets reacted early, not as strong as the European markets to the downside, but overnight, the 4, 5, 6 a.m. hour when futures were trading at that point, we're really seeing a lot of weakness, this big fear that's going on about what this all means, especially going into winter. So that was a big issue. And usually this time of year, there is a slowdown of activity. Liquidity is removed from the markets because a lot of times traders are on vacation. You have to wonder, will we see that this year? I mean, vacations are a lot different right now. Maybe a lot more people are sitting at their desk. So we're not really sure what the case may be this year, as there is a change that people may be sitting at their desk throughout this particular season, when usually we see that there's a lot less that goes on until we get to the end of the year and a few things happening. But we are in the end of the year. We are seeing some of the painting of the tape. We're seeing some of the market rotation, the tax selling that goes on, and the rebalancing that goes on. So we're seeing a lot more volume that will probably hit towards the end of the year as we get through it. But this week or so, that Christmas week was usually a pretty light week. Of course, we know that markets are closed on Christmas and on New Year's Day. Is that this Friday and next Friday coming up. Amazing that we're at the end of the year to begin with. And with that, we're seeing some other issues that are really kind of, I don't know, some weird, again, a lot of weird things going on. And we have this concern over a peaceful transition of government that's happening right now, where there's some talk about, possibly continuing with this idea that Biden didn't win and there was fraud and we may institute martial law. And there's just a crazy amount of things like the Georgia runoff. How does that really impact things? The virus stimulus was approved, but there's some concern about certain areas, who's getting what and what's not happening, and the handcuffs that they may have put on the Fed with regard to the Main Street lending programs and things like that. We have Navy ships that are entering the Arabian Sea, lots of strange things that are happening right now. So with that, you would expect that markets would be a little bit, weak, especially after the run-ups that we saw. Meanwhile, at the same time, towards the middle of the day, they really sparked up pretty well. That again, the dollar started selling off, which is a nice tailwind for multinationals. There was some news about Apple coming out with an electric car in 2024 midday. Tesla entered the S&P today, sold off pretty hard actually. But there was some kind of interesting give and take there today on markets, but yet not as weak as you would have expected. And that just goes to our discussion that we've been having about the underlying bid in all this. While a lot of people are not really understanding what that's all about, there is a lot of concern about what really is happening in terms of the overall, the overall markets and people buying without concern about valuations, concern about the pandemic. Looking through really is what's going on to the future about what's going to be happening. So anyway, thoughts on that? We could also welcome discussion on as well. I think I covered a good amount of what I was going to cover. So let's get to some questions. And we have a pretty good sized group here today. Only one or two questions in there right now. So if you do have questions, get them in. Otherwise, you know how it goes. We end early, right? If there's no questions. So if you have some questions, you want to talk about, directionality, you want to talk about rebalancing, rotation, you want to talk about general portfolio issues, you want to talk about inflation, you want to talk about, commodities, whatever it is, free range to talk about whatever you want. So with that, let's get to our first question. And like I said, we'll go as long as there's questions here. This is from Carl. He says, hey, Andrew, according to Fred, the M1 money supply has increased about 15% in the past month, despite the market being near all-time highs throughout that time. Any thought on why and possible ramifications? So it depends on how you want to look at this, I think, Carl. We talked about this M1. Yeah, there was a significant increase in M1 overall. And there was this, you have to wonder what came first, the chicken or the egg. The M1 money supply, which includes cash at banks and certificate deposits and demand notes and readily accessible cash, if you will. You have to wonder what happened first. I'm of the thought process that actually what happened was that a lot of money was pushed into the system, was pushed into the overall markets, and that's what helped to free up liquidity and then to therefore increase the stock market. So it kind of, your question looks like you thought it may have been the opposite, which may be, what's the causation or correlation to this? I think that there was a significant amount of increase, and that flood of liquidity that came in about the last 30 or 45 days in particular. There was a lot more coming in over the last several months, and the Fed is doing what they can, but that fiscal stimulus that came in, the low rates, the quantitative easing, the buying of bonds, it just really did see a significant amount of money that came into the system. And I think that there was that caused a lot of the upside in that, and I think that was part of why the markets went up so dramatically. So hopefully that answered that question. Next question, which see any other questions here today. A very quiet audience. I think we're getting, I got a couple more. Is from Aaron. He says, he sent me an email today. He was talking about rebalancing. Make sure I get this right, Aaron, from my memory. It was a discussion about how, he had some overlap and he had some concern about selling a few things in the portfolio to rebalance, to bring things back in line. And then what happened there was that some of that would not be tax deductible and or not tax deductible. It would not be a taxable event, so it couldn't get the losses on some of those because it was inside of an IRA or other kind of retirement plan. And was that advisable to do? And what I thought about it. So what I said and what I think is the discussion that has to be had here is the idea of, do we in fact look at the idea that we want to make sure that we could always have the most tax losses flow through versus gains? Well, of course, that's if it's possible, but we don't want the dog to tails to wag the dog. We want to make sure that we are in fact looking at things like, what is the proper balance? And if I have overlap in my portfolios, and maybe I need to have an overlap and overage in a particular sector, particular stock, a particular area, particular asset class, compared to where my portfolio model should be, I think you take that as the first line. You look at that and you say, let's rebalance this and let's look at this, and let's then go and say, okay, number one priority is to look at what's happening inside of the portfolio and where you should be situated in terms of your balance and your allocations, et cetera. Secondly, okay, then let's look at the tax implications on all this, and how does that actually play out? So I think when you do that, you need to look at your portfolio and see where you are allocated according to your risk tolerance, according to your time horizon, and see if everything is set. Rebalance, or at least set the rebalance up where you think you should be, undoing that overlap and making sure you're not too heavy on any particular area. Then find out, okay, what are the tax ramifications of me doing this? And if you don't get the tax losses flow through, well, that's okay. It doesn't always happen that way. But make sure that number one is the idea that you are looking at your portfolio first and foremost. Next question comes in from Ron. He says, hey, hello from Pennsylvania. Thoughts about EV stocks like NEO, et cetera, like everything massive run up, but thoughts long term. Well, there are a lot of those right now. Many of them are in SPACs, and obviously Tesla being the granddaddy of them all. That news from Apple today should have some implications for some companies here in the US. But one of the things that we do see is there's a lot of competition that is coming in. We saw that the Hummer was seeing massive demand, and that was a news item out today. And EVs are seeing significant demand. So there is an opportunity. But remember something, just because there's demand, just like what we saw with the pot stocks a few years ago, does not mean that long-term all these companies will be successful. So I think you need to look for those that are proven or at least have the backbone to keep things going. You know, some of the names like the GMs and the Fords, which may be dogs compared to a Tesla, do have some interesting opportunity that they can bring to the table and sustainability in terms of their financial staying power. So something there is kind of interesting to think about. So something to look at, something to think about in terms of looking at all the different companies that are out there, as well as the components that are involved with that, whether it's the self-driving autopilot, the software, the development, the hardware, as well as everything. But there is big demand, and you would think that as that demand comes through, that the potential profitability will be okay and spread out a little bit. Understanding that, you know, there are tax credits and other things involved in the EV space that some companies will benefit from and do well from. So I would look at outside just the obvious right there. Next question from Ben. Do we have an indication of what the M1 for December is or when it is calculated? The graphs don't seem to show that. I think they're every 2 weeks, Ben. You can look at a variety of places. I think if I'm not mistaken, they are put out every 2 weeks. So you'll probably have another, well, shortly. They'll be put out shortly. I don't have the exact dates on them. I'm sorry. Next question comes from L. He's Andrew, the markets is nominally near all-time highs in dollar terms, but how is it doing when denominated in gold? Do you have a graph? I don't have a graph on that, but you know, I don't know. I separate these. I can't necessarily look at, you know, why don't we look at it in yen? Why don't we look at it in Bitcoin terms? Why don't we look at it in some other terms? I mean, the U.S. Markets are based in U.S. dollars, and therefore, I think that's an important thing to look at. I'm not saying this isn't, you know, an interesting thing to look at, but I'm not sure how you benefit from that. You know, you could simply look at the S&P 500 ratio to GLD, for example, and that will give you what you want to look at. You could probably do that on any chart, like stock charts. Just do a quick ratio. But again, I think you need to have some of all of that in your portfolio. We don't really spend gold, do we? We collect gold. I don't know many people that buy things in gold. So therefore, I'm not exactly sure what the benefit of utilizing gold as a benchmark or base currency when looking at alternative assets. Again, it's an interesting thing to look at. And if you believe in gold, and that's something that you feel because of inflation in the future is going to be popping up, then you definitely should look at that. So anyway, hopefully that answers that question. Oh, now a string of questions came in here. Let's see. Carlos says, hey, Andrew, where can I find a good source for the key reversal indicator and how has it been predicting markets lately? Remember, the key reversal indicator, first of all, it's available on TradeStation on the trading app store. That's the only place it is available. But one of the things, or the only thing the key reversal indicator does is really kind of tell you when things are really too hot. Well, right now they're, you know, +1, +2, came down from +5 a couple of weeks ago. Right now we're still in that kind of that market neutrality zone, market in equilibrium zone. It's only these extremes that we really pay attention to with it, because even if it's a +3, it's like, okay, markets are hot. What does that mean? Well, we can continue in that direction. It's a -3. What does that mean? Well, market's a little oversold. What does that mean? We can continue in that direction. Only when it gets to like the ±5 or 6 or 7, if it ever gets there, hardly ever does ever. But it gets to the 5s on the negative or positive side. That's when it's kind of like, hey, be careful, you know. And then I'm going to throw out there also that it's not really, in my opinion, best to use absolute market timing on any particular indicator. It just doesn't work. What we use this is with a combination of other planning mechanisms, like, for example, when things are oversold, do we have dollar cost averaging on an opportunistic basis that we want to add to a position? Or if we are allocated a little hot somewhere, do we want to look at when things are getting too hot to take some off the table and rebalance? Does that make sense? I hope that makes sense. It's also a big picture item, very big picture item. Let's see. We have a question from Ben. Are there strategies that we could use to convince organizations like HSA holders through work to allow more options such as ENT instead of the crappy Vanguard hedge funds or mutual funds that provide the mimic of the indices? Some of the Vanguard funds are not terrible. I mean, they're cost effective. They're inside of a tax deferred vehicle, so therefore you're not going to have a problem with the cap gains that come through as much as you would, if you're worrying about that for ETFs. I don't think there is. It will be a reckoning one day that they will turn it over. But right now, Fidelity and Vanguard and all these guys have the market on 401ks, HSAs, and various programs. Therefore, you're probably not going to see a lot of movement. Trying to extract from those and go into either a custom plan or a self-directed plan is often an expensive proposition. Tim asks, Andrew, do you see these new shutdowns in the UK and other parts of Europe likely to bring more stimulus there too? Therefore, probably not weakening the dollar more than it is. You think UUP levels are not factored in with this potential? I don't. It is possible that there is the EU just announced more stimulus and more quantitative easing like 2 weeks ago, within 2 weeks. So I think that the concern is that we have a lot more situation here, and it will be coming to us anyway, with regard to an increase in the pandemic, and that the Fed is a powerhouse that is going to keep rates at these low levels to 2023, which yields us a significant amount of opportunity for the dollar to continue falling. Anything's possible right now. The dollar has been in a trend lower, and traders are playing that. So I think that's what's going on right now. But, when it comes to this, I still think that the opportunities are to have some of your investments on the stock side outside of the U.S. in emerging markets, in foreign bonds and emerging market bonds, et cetera. That's where some of the opportunity lies if the dollar is going to get weaker. How much weaker? Again, we're at a point now that it's there's some support here. Not great, but some support. But the trend is absolutely abysmal for the dollar. Ben has another question to the market terms question. An interesting indicator is the lumber up gold ratio. Yeah, I would agree with that. The lumber to gold ratio, the lumber to gold ratio. I think I misspoke that to begin with. That is interesting. Ken asks, he said, Frank Kersey was talking about security tokens as being the new stock market. What's your opinion? I'll be honest with you, Ken, not an area that I've really wandered into. I understand a bit about them. I understand what they're doing. And it is we'll call it an alternative market, not stock market, but an alternative market, kind of like cryptocurrency is. In a way, it's an alternative market, like commodities are an alternative market for trading. It's something different. I don't, you know what? I can't answer that. I don't have enough information to answer that. Ben says, Kathy Woods brought up an interesting thought in the Bloomberg interview using FANG stocks as store of value versus fiat and not Bitcoin because of unqualified income penalty. Unqualified income penalty because of the unqualified income penalty. Yeah. I don't know. A store of value, these catchwords, store of value or path to profitability or, these kinds of things that we start to hear about and the conversations, stay at home and pandemic plays. These are all ways to get people to get bullish on your idea. I can't imagine that using a FANG stock as a store of value when they have massive amounts of cash on their balance sheet. The stocks themselves are based on dollars. And it is interesting. I don't know. I mean, if you think about like some of these markets like Argentina, Venezuela, the stock markets go straight up into the moon, but yet they have massive inflation. So then you sell back into I mean, it's interesting point. The unqualified income penalty, I haven't really thought through that if that's an interesting way to go, but I don't know. You do have a lot of risk. I guess if you're looking at the thought of having a store of value, which I personally think a store of value is something that has value and I store it that doesn't have a lot of volatility, but that's me. But if you're okay with having your store of value being in something with a lot of volatility, then I guess that could make some sense. Same as Bitcoin or ETH or whatever these other cryptos are, where you can have a store of value theoretically, but yet have, an 8% variation over a weekend. Not my cup of tea. I just don't think that it's an interesting investment. I'll go there. I'll go there with that. But a store of value, it's like saying, hey, instead of my CD, do I want to put in Bitcoin? I don't know. Was your CD supposed to be used for a down payment on a house or something? And you want your Bitcoin having that day that you need to take the money out, go down 7% or 8% or 25%, and then all of a sudden say, well, I have to wait longer and hopefully it comes back. I don't know. Last question. Question or the comment is Yellen pressed back to strong dollar and reversing Trump era tone. What's your take? Can she reverse the downward trend of DXY? They all talk about a strong dollar. That's the Treasury's job. Strong dollar is what the Treasury always says. I don't, the president may have something else to say. The Fed has a lot more to say. Stimulus has a lot more to say. They can talk all they want about a strong dollar. And Yellen talking about a strong dollar, by the way, is a little weird. That's a little weird. So it could reverse it. It's all, though, about what actually happens. The commentary is not going to necessarily do it, because we know at the end of the day that, many in the Treasury want to try to drop the dollar value down to create these tailwinds for not only companies, but obviously it's a better deal for our economy as people could buy our products a lot cheaper. And therefore they come in and it really gooses our economy. So the weak dollar is actually a good thing for us. And that's why you see that a lot of times, particularly manufacturing and exporting countries like Japan, the dollar or the yen value is a very important thing to markets and overall economy. So that's kind of like what's happening here right now. So there you go. I'm going to end it a little early. I got a couple of things I actually got to do today. So that's good that there was only that many questions. I'm happy about that. So we have our last one of these next Monday at 4:30. Be there with your questions. Think about your questions throughout the week. And then what we'll do is we'll answer those. Of course, DH Unplugged tomorrow night at 9 p.m. live. So let's go there and be there and check out this week's Disciplined Investor, some financial planning tidbits in there. Thanks a lot for joining me, and I'm going to see you everybody next week.